Let's try. So the topic is the road to off-chain regulations. And the company is Mt Pelerin. So first, let's introduce myself. So I'm Cyril LAPINTE, and I'm CTO of a project which is called Mt Pelerin. I have background as a software engineer, different kind of stuff. And I'm also a lot involved into social meetups, some conference, like in 2 days you have the Agile to London. And this is my timeline about blockchain. And you can see I joined the space a bit late compared to some of you. And I've already in London about a tracking record of a blockchain achievements. So now I'm working at Mt Pelerin in a startup. So let's start a little bit of politics, because at the core, blockchain, it's about politics. I hear some voice in disagreement. Well, we'll discuss that. So do you believe in blockchain values? So what are those values? You have the economic values that are beneath this ecosystem. At the origin, you have Adam Smith. Maybe you're familiar in London about the guy called Adam Smith. Well,
we have no money.
And you have the idea of free and open markets, private ownership of capital values, and also individual contracts. Already those guys from economic liberalism, they are talking of contracts. But reality check, an authority is needed to define, regulate, and enforce rules. So in the blockchain space, you don't have necessarily it's self-regulated, so it's a consensus. The authority is a consensus, but this authority of consensus can't apply outside the blockchain space. So if you have a real use case in real worlds, you can't have the blockchain enforcing it. You need someone that will go in the real worlds to help you enforce what has been defined on the blockchain, if you were to consider blockchain as a primary ledger. Now let's talk about on-chain governance and regulation. So, as I said, real world must follow existing governance and regulations. And if the real world, you have a government and you have an administration that will run the system based on the government decision. You have basic rules, which are you don't steal the guy next to you, you don't try to launder money, and you have many more rules that you probably already very familiar with, even if you're not a blockchain people. And on the other side, on the blockchain space, you have different set of rules, but you have also a set of rules. You have miners and nodes who run the system, and you have rules like you cannot spend someone else's money. What I mean by you don't own the private key, you can't spend the money. And you have other kind of rule. You cannot replay transaction. You cannot rewrite history. Well, you said that you can't rewrite history. I like to disagree, because you can always rewrite history on blockchain. Blockchain is mutable only by consensus. So if everyone were to agree on Ethereum to rewrite the history, then you could. But it's a joke. It's a joke. Consider it as a joke because it's very unlikely. But it's, yes. So now, maybe you're familiar. Who is not familiar with the token classification here? So, okay, you're mostly already familiar. So I'm just rephrasing stuff that are very general and already known, because that's the basis on which I will go further. And I want to be sure that everyone is familiar with this rule. So right now you have the financial regulators across the world, FCA included, FINMA, SEC, and others. They propose these following classifications. I think I got it wrong somewhere in the layer in the presentation. But the more let's say security token is the one that's highly regulated. You need all the regulation that applies right now to bank and financial industry. which is KYC/ML, qualified investors, and many others. And all investment tokens, they will be classified as securities. So now you see already a discrepancy in the blockchain worlds, where you have a lot of ICOs that try to not be within the security tokens, but because they are invested as investments token, they will be in the end defined as security. I think there was someone that said, if it looks like an investment, if you said that it's not an investment, but it looks like an investment, it is anyway an investment. I'm sorry, I can't say it the way the guy said it, but that was very funny. I'm just not funny here. Sorry, guys. Then you have the payment token. Payment token, the classical one are Ether, Bitcoin, which are not used to invest or to build a project. They're just there to do transactions. The limits is quite not always very simple, but really consider the idea that if you put money into something, the guys on which you have invested, the team on which you have invested, they owe you back something. That's an investment. If the guys who define those tokens and build the system just offer it without any reciprocity, then it can be a payment token. I say it can be because the distinction is not always very clear. Then if you want to switch back and forth with fiat, there is some regulation that will apply. You will need like KYC, like those done by exchanges right now, because they are payment tokens. It's a bit more complicated than that, but that's the general ideas. And then you have utility tokens, which have no purpose, which have the non-financial purpose, and that doesn't fall into the previous category. The idea I use generally to explain what a utility token is like if you have a board game and you have a token that's not tradable. Like imagine a score token, a token that represents the score you have, but you can't sell the score because in some games, some very funny games, you can even buy and sell between players your own score. So that's why I'm saying that the definition is not very clear. It's a bit, it's not very precise. So if we look again in the exchanges, I was there when Vitalik said, I don't know if you remember that, he said, I definitely hope centralized exchange go burn in hell as much as possible. And Vitalik was sitting here, and next to him there was a guy, which was the CTO of Coinbase. And he was just next to him, and he said, just like that all exchanges, all centralized exchanges should go should burn in hell. So why that? It's because there is a lot of concerns. There is a concern about a financial point of view, not only, but there is a concern about financial point of view, where exchanges operate in a gray zone. The fiat money is very regulated. Banks, you always have the banks when you have fiat money, you have the banks which is involved at some point. So if the exchange doesn't own a banking license, he has a partner which is a bank which operates for him all the highly regulated parts. That's why you still need to do KYC/ML, and there's quite other things as well, but this is the general idea. And also you have the fact that for cryptocurrency, it's pretty much hell. So I say at best they do consider cryptocurrency as a payment token, but this is not the case. Consider that exchanges, they don't necessarily own the Bitcoin they're selling. So it's not the blockchain value. The ledger on the blockchain is completely opaque. You can't have it. So you can't challenge that they're selling Bitcoin that they owe. No. So sometimes they will just create bitcoins out of thin air. They will let people trade between themselves on the platform, because most or many people don't leave the blockchain and hold the crypto on their own private keys. And as we say in the blockchain space, if you don't own the private key, you don't own the money. So exchanges are centralized exchanges are a big problem. Decentralized exchanges doesn't have this issue, because the decentralized exchanges, they're on the ledger of the exchanges is on the blockchain, so you can really challenge that blockchain values and blockchain rules apply there. So now let's talk a little bit more about compliance. So you have, I mentioned already, you have the know your customer, the KYC, know your customer policy. It's identifying the customer, discovering his assets, and qualify his profile. I mean, his investor profile. So you can't do the same thing on someone which is qualified investor than someone which is just a guy in the streets. A qualified investor will share responsibility in the investments that he makes. He's supposed to be knowledgeable in what he does, where the guy in the streets, you have to protect him. So all consumer protection will apply to the guy in the streets. So you really can't do the same thing. A structured product or a derivatives or complex mortgage, structured mortgage, you can't do it to a guy in the streets. You can't sell it. You have to sell it to someone that you are in measure to prove that these guys knew what they were buying. And then you have the anti-money laundering policy. Avoid forbidden use. So you can't process money as an intermediary or a bank. You can't process money that's linked to crime or terrorism. You have to detect complex patterns that people use to hide or mislead information. Like in AML, usually we talk about a threshold that when you're below, it will be too costly to fine grain analyze all the payments. So you don't look when the amount of the transaction is very small, because it will cost you much more to the system. So some people try to make a lot of small payments to hide with large amounts. So you have to detect, part of the AML policy, you have to detect those kind of patterns that try to hide behavior. And also for the large one, you have to do the correct analysis, which can be very complex sometimes, because if it's a complex sale of shares from corporates where you might have a shareholder rule that applies, where you can't have a majority of the share or something like that, it's require a lot of auditing to be sure that you follow the rules. So the bigger the transfer is, and the more check that will be applied to the transfer, because the more risk as well is for the bank or the intermediary, so he will do the extra check as well. So now at Mt Pelerin, we're doing something very original. We're doing what's called the bridge protocol. So it's a smart contract driven protocol on Ethereum, where you execute on-chain those compliance rules. We define at the core what's check need to be done, how you can do it, and we process them, we define them as smart contracts. So it's fully transparent, fully editable by anyone. We have a limited centralization, because on the regulated world, if something bad happens for whatever reason in the world, you may have a judge or the law authority that's come to the bank or the financial intermediary and ask this entity to execute or enforce decision. I don't like to say too much about it, but seizing money has to be designed within the protocol, so the legal authority may seize your money on the blockchain. So we have something that's allow a specific private key we give to the legal authority to sign operation, why he does that, or at least when he does that and how he does that, so he's accountable later on for the decision he made. He has to assume the decision that he has been made because he has signed with his own key this operation. So that's what I mean, auditability and accountability. In the bridge protocol, we try to tokenize all financial assets. This includes, as I mentioned, fiat, but also shares, loan, and other in the future. Because it's on the blockchain, it's an open infrastructure. It means everyone can look in the back office of the bank, of the platform. Everyone can have a look at how you are executed, at what cost, at what price, and how, with which rules you've been executed. In many banks, if you're the big guy, you execute it faster or at better condition than if you're the small guy, particularly in exchanges. If you have a lot of money to cash out from your ICO, don't go on the exchanges. Call the managers of these exchanges, try to find directly a deal, because he will front run the customers and try to give you the best deal, because you come with a lot of money, so more volume for him, which is in itself criteria of the interest of the exchanges is how much volume do they have per day. So if you can bring more volume, maybe they can even pay you for the more volume you bring to them. Another interesting feature in the bridge protocol is that not only we open the infrastructure to be accountable, but we also open it for execution of smart contracts to other banks partners. So the idea is not to be the only one Oracle operating it, but to operate along with other banks that will be willing to share this protocol together. But we also want to open this protocol to non-bank or individuals that are interested to develop their own smart contracts on fiat, shares, loan. Anyone, any guys of you, without any banking regulation, will be able to do it with the bridge protocol, because the tokens are compliant inside themselves. So whenever you manipulate them, you're compliant with the token. So yes, the token, if you go deeper in the details, you'll see that the token has this feature, the following features. There might be a limitation on transfers based on what I mentioned before, based on the KYC and the AML rules. So if you're not KYC, there won't be problem for small transfers. But if it's a big transfer, then as I mentioned before, we need to do extra check potentially, and we'll need to be able to approve your transfer or authorize some transfer. The way it works is also it's linked to a KYC. So if you're a big company owners, large building or large companies, and you have a lot of money, you have billions, you will have a limitation which is not the same as the guy in the streets. Well, they customize for you the limitation that fits your needs. But we'll be able to do that because we have identified you. The identification is not done on chain, it's done off chain. On chain, you just have a link, an ID that references you for the smart contract execution. That's a limited and optional user KYC that I've just mentioned. The token also has the ability to extend and upgrade rules. We know the rules today, but part of the regulation world, you need to be able to change it. On the blockchain, when you want to change the rules, how do you do? You try to do a soft fork, but if you can't, you have to do a hard fork, which is something that has to be agreed by consensus by the community when you're doing a hard fork. Usually it doesn't go, most of the time it doesn't go so well, but it has to be agreed by the community. So if we want to bridge both worlds, it means that a change on the regulated world must not need a consensus of the on-chain world. Because that's not the decision of the on-chain world, it's the decision of the regulated world, which has its own rules and authorities and governance rules that drive himself. And one world cannot change the rule of the other worlds. Each one has its own way to work. And as I mentioned, you have seizability, which is done in a way that the guy who sees, the authority who sees, is accountable and auditable. So as a bonus, based on that, what I've just described, you get as well this following one. So you get the ability to have proof of ownership. So you're going to tell me it's a blockchain. Everything is accessible and visible. It's a blockchain. But on Ethereum, in particular, if you're a Solidity developer, you know that you can't access the history of the blockchain. You can't access the logs. It has to be on the states. It would be highly inefficient and very expensive to try to store all transactions on the states. Basically, it won't work because it will grow, and the system has limited capability for the states manipulation because the log and the backlog can be pushed away on the hard drive, whereas the state has to be within the EVM context. So the idea is that you can request to have a proof of ownership on chain. So it gives you a description that between that time and that time, between the two dates, you had that amount of money. And because it's based at the ERC, so it's an ERC at the token level, whenever you do a transfer, you can check that it was modified or you had the modification of the transfer. So you're able, when you ask for a proof of ownership, it will go back in time, look at where was your last transfer, and it will tell you that during that time you have that amount. You can also request automatic proof of ownership on transfer if you ask for it when you do a transfer, which will generate exactly on the time you had the balance. And you also have the ability to have claims which relate to the proof of ownership, which is dividend and voting rights. This is more for the shares, by the way. You can have it for anything, but it makes sense to have dividend and voting right on shares. And the bridge token is already alive. It's on the mainnet. So yesterday, we have been approved by the Swiss authority in the canton of Genève. In the Geneva canton, we have been approved by the Swiss authority, which make our tokenized shares legally valid. What does it mean? It means by participating or by having the tokenized shares, you will get the protection of the Swiss authority. If ever we try, like some ICO or some other investments, we try to go out with the money. If ever we try to do that, then we'll be sued by the Swiss authority, which is quite powerful. Yes, it's on the Ethereum mainnet. So behind this token and this protocol, you have a project of a bank, a Swiss bank. Why do you need a Swiss banking license? Why would you need that? You need that on the regulated world to accept deposits. So if we want to accept a customer money, we have to have a banking license or depend on another banks, which is having one, as I mentioned. Because we would have a bank license, all the asset of customers will be protected up to 85,000 GBP. So the GBP is obviously by the, if we were having a banking license in the UK, it would be 85,000 GBP. In Switzerland, it's 100,000 Swiss franc, which relates, it's the same kind of idea. So when a bank fails, then the states, the government or the authorities refunds customers up to that level, which is very important for guys who don't have large amount of wealth. They can't accept to lose any kind of amount of value because they depend on that to live every day. And something interesting why to do it in Switzerland is because in Switzerland they have a very, very old, well, few centuries old governance, and that governance is already quite decentralized. So there is no powerful state authority. There is much more power on the lower level, the canton first, and then the city and the community below. And also, we want a bank because we want to provide a new paradigm, a new way to do banking. If we were to rely on bank, we'll have to follow the rules of the existing banks. And because we want to change the paradigm, we need that license. What I mean by changing the paradigm is that we want to be full reserve. What does it mean? Right now, if you have your money in the banks and you ask for a loan, for example, they don't have the money they're gonna give you for your loan. They will create it out of thin air because they have authority from the central bank. Central bank gives to bank the rights to create money out of thin air, which means that somehow they're playing with the citizen money. Another way they're playing with money is that the money you put on the banks, you put at the banks, is not staying there for you, waiting for you to withdraw it. It's played on different markets. So when something goes bad, like in the subprime crisis or other crises, the whole system can fall down because there is no money. Your money is gone. You give it to the bank, you trust the bank for that, but your money is gone. So being 100% full reserve, it means that your money just stays there. And because we are on the blockchain, it's easy to be accountable for that. It's easy to check for that your money is there. As I mentioned, we build around an open marketplace, and we will provide hybrid, seamless on-chain, off-chain user experience. So your banking accounts will provide both the on-chain experience as well as the off-chain experience, which you can also use a standard ERC20 wallets, any kind of wallets, if you want to manage it on your own because you want full ownership of these assets. Why do you need off-chain? You need off-chain because on-chain is very powerful, it's transparent, it's provides auditability, accountability, but it will never be as performance in terms of speed and cost, particularly for small amounts, so the off-chain will be much faster and much cheaper on small transactions than the blockchain can ever be. This is because when you have one guy deciding for everyone, it will be always a quicker, faster response system, governance, than when you have to discuss with everyone and agree together in a consensus to a decision. Democracy is great, it's powerful, but sometimes you need less democracy and more efficiency. It's dependent on the business context. So Mt Pelerin is a new kind of Swiss bank. So we'll try to regulate all kind of financial assets and put it on the blockchain through a token and its tokenized version. And if you want to know more, we have the websites, and all the code that I mentioned is on the GitHub. Not all the code on GitHub is on the main chain, but the token that I mentioned, the bridge token, is on the main chain, and this bridge token represents the shares of the company Mt Pelerin. So that's it for me. You seem very serious now. It was not a very funny topic.
Cyril, I've got a big question for you. How confused do people seem when you're bringing this to a banker who has no idea really about the technical side of things? What's the big challenges that you face dealing with those authorities?
So you mentioned two authorities, which has a completely different view on the matter. So you have the authorities and the bank. Banks are some of financial authority in itself, but they're completely different from the regulators. Banks has different problem, different perception and different understanding. So you have some bankers that do understand what we do, and those bankers might be scared by how we can disrupt the business, because it's like putting all the inefficiency open for anyone, any customers to see. You have other bankers that are not familiar with technology, that just don't necessarily understand exactly what we do. Those are the guys that do private blockchain. Well, today I heard on Twitter, a centralized blockchain. If some of you can explain to me. So that shows that the understanding is, we should not laugh about those people because they try to understand. Maybe I'm naive, but I think they try to understand, and that's where we need to explain them that, yeah, centralized blockchain or private blockchain is like black and white, is not the same thing.
Thank you very much. Does anyone else have any questions?
Yeah.
Let's take questions.
So if I understand basically, hi, thank you for your presentation. So if I understand basically what you're proposing is narrow banking or full reserve banking, which is as opposed to fractional reserve banking, right?
Yes.
I've come across several projects trying to do this kind of things, including here in the UK, and where they struggle the most is you need a lot of capital, regulatory capital, to get the registration. So I'm wondering, how things are in the canton of Geneva.
Let's.
And I'm trying also to understand your bridge token, whether you're effectively doing a security token offering to try to fund this, or if they're two separate
So
things.
let me ask you first a question. Are you from the banking world?
I escaped the banking world.
Because you look familiar, really knowledgeable. And
I used to work
this is a very.
IT, so I used to set up the systems where they put in the numbers and billions appear out of thin air.
I'm delighted to have your question. So you have two questions, let's say. The first one is about if you go full reserved, what you mean is that you have a liquidity problem. And the one way to solve it is huge amount of capital. If you have huge amount of capital yourself, you have the liquidity, which is fine. Another way to do it is using technology that bring liquidity. And interestingly, blockchain provide liquidity. When you get tokens, so the share token is not exactly this case, but the reference of a ERC20, it's 18 decimal. 18 decimal, it's dividable at the infinite. So basically you get a big capital just by shifting the zero with the decimals. So you simulate liquidity that way. That's one way to achieve liquidity. Another way to achieve liquidity is to make the assets more transferable. So on the blockchain, on the banking world, the way transfer works, maybe you can confirm what I'm saying. I've worked in banks, but maybe all banks are not the same. You have batch overnights. And the time it takes for an operation is counting days. Why? Because you take only one batch nights, because then you double check what those all mainframes from the 60s have done on the nights, and that you're so scared to fucking touch them. So you just check the other day, you check what has done. And when you have 5 batch to run consecutively, it means you're going to take 5 days. So that's an issue on traditional banking industry. If you want that prevent liquidity in that way. There's other ways, but generally speaking, my point is that technology may be used to provide liquidity. If you change paradigms, then you can offer new features. And I think we can go full reserved because of the use of the blockchain, which it's much harder to do on the other way. Then you asked me another question. Can you just repeat it? I'm sorry. But there was another question.
My point was when you go to the regulator and they say you need to have 5 million Swiss franc in the bank account, otherwise we're not going to give you a license. Where do you get that 5 million?
Oh yes, you was talking about security. So I remember the question. So I will answer the bank license problem. Just go back to the issuance. How do we gonna raise money? Well, maybe I should be the way around as well. So yes, you need in Switzerland, you need 30 millions to have a banking license. It's one of the most expensive places in the world, maybe, but because you also in Switzerland, you offer so many governance values in terms of transparency, accountability, already within the regulated world. It's one of the very few corrupted country in the world. So it's very valuable to have this in Switzerland. So you need 30, I'm exaggerating a little bit. Basically, you need 1/3 of that amount in that you put on a segregated account that the regulator will take for him if ever you screw. For whatever reason you screw on something, he will be able to see that money and take it away from you. So that's money you can't touch, you can't use. You just need 10 million for that. Then you need 10 million almost to all the audit process, due diligence to set up, to organize, to review by the regulators. It's many lawyers, many hours of lawyers to finance, let's say, this license. And then the regulators look at you and say, interesting, you put 20 million now. Are you going to operate now? You need a little money to pay all these people. So they ask you to have like 5 years of operational money. So that's having a bank license in Switzerland. In other countries, it's more or less, it can be simpler. But you have this same kind of patterns, but much cheaper. So yes, we're going to need a lot of money for that. So I can't discuss all that matter right now because we try to do it legally and then legal rules applies. So as I didn't do the KYC yet, I don't know exactly who you are, so I can't really speak about that. What I can say that we're not doing really STO in the protocol because the STO is a token that the regulator sees as a security. But because it's just a standard token, you can't apply the rules of the regulator with the tokens. So basically you screw and you're in gray, at best case you're in gray zone, more probably you're illegal in what you're doing. 90% of ICO are illegal and potentially scams. Potentially, because most projects are, I'd say, naive, not very knowledgeable in terms of compliance. They're tech people. I'm a tech people, so I can relate. And we're not trained, familiar with legal, and we only discover legal after that, after we fail or after we gone through something. But that's too late for legal. You have to do your due diligence before. If you want to do a bank, you have to hire a lawyer, accountant that are officially approved by regulators to process this kind of stuff. So yes, STO is not the right way to do it. That's why we use the term tokenized security, tokenized shares. Because what we do is the shares that's registered to authority, Swiss authority in this case, and then we tokenize, we put tokens. And in the shares holder or in the shareholder agreements, we say that a token has the same value as shares.
So we'll have to leave it there.
Sorry.